Meg, what are you most focused on?
We are most focused on the Fed, as is everyone else. So clearly watching a lot of Fed speak. We had a great amount of data coming out last week. And as we mentioned already, looking at wage inflation, looking at the GDP for Q1 being sort of a temporary downturn. But one of the things that was mentioned earlier is this consumer sentiment being very high. And we've continued to see that strength in auto sales, which gives us some confidence that the U.S. economic recovery is a little bit stronger than that Q1 report indicates.
Ron, when do you think we're going to see a rate hike?
Well, it's pretty well signaled that you'll see a rate hike sometime this year. I'm not convinced it's September, but we'll see a rate hike. That's not the question, though. We will see a rate hike because we have to get off zero-bound interest rates.
Are you saying I asked a bad question, Ron?
Yeah, I did think.
I just want to point that out.
No, I think the question is the next series. What's the signal?
What happens after that?
What happens after? We're going to have a rate hike, and we probably should. We got to get off zero bound. But then the messaging about the slope of rate hikes is going to be extremely important, and that'll have more to do with the future of markets in the next rate hike.
I agree, and we've got the markets already now pricing in 2/3 of a rate hike in September. So we think the market's been pretty well messaged through Yellen, but Yellen's also been very cautious about saying it will be gradual because she doesn't want to spook the markets and have the type of outflows, as you mentioned, that we saw during some of the...
So the analogy that people like to use when they talk about the need for that kind of a rate hike is to put bullets back in the chamber, right? Or at least into the magazine. So what's a bullet? Is 25 basis point enough of a bullet? So does, and if it is enough of a bullet, does the Fed need 1, 2, 3, or more rate hikes to be able to actually do something in the event of a recession?
So I'd turn that question around, which is, are you going to notice when the savings rate on your checking account goes from 0 to 0.25%?
No.
No. So,
So
really...
in other words, it's not a bullet then?
No, and I also think people borrowing at floating rates aren't really going to notice the interest rate change that much. So I think there need to be more steps. I think it should be done gradually, given how long we've had this low interest rate policy. But at the same time, I don't think it's giving them a ton of ammunition. We've
had this long low interest rate policy for as long as we've been looking for the recovery.
Yes.
Okay, I just said, someone said, we're looking, here comes the recovery. We've been looking for this recovery since 2010. Still not here. Whereas we have not had, at least in my way of thinking, we've not had 4 consecutive quarters where GDP has been 3%.
Okay, but consumer confidence is coming back, as we've discussed.
From what? From like the bottom of the barrel.
Well, let's use small business optimism, because it's close to 100 now, according to the NFIB, and I mean, I'm just looking at this chart. Long term, going back to 1990, 100 is more or less the long-term average. So if small business feels good enough about the prospects for this economy, what's not to like about the future? Not where we are right now, but where we are 6, 12, 18 months from now.
Look, I love the future. I've just bought a bunch of businesses on optimism for the future, all right? But what I would like to see is GDP growth, okay? That's what I would like to see. We are leaving trillions of dollars of economic growth for our children on the table through policy and other things because we cannot get back to the 80s to 2007 3% GDP growth. We're not even close.
Don Constant from Deutsche Bank was with us just an hour ago saying what we need to pay attention to, the fact that workers are less productive than they need to be. Yes, more people are getting jobs, but the output just isn't where it needs to be. He thinks that's the reason we should hold off on raising rates until 2016. I
think it's an interesting data point. I think it's mostly Q1. But I think what is more concerning to me is that people look at the labor force participation rate and they say that's still a little bit off, and what we expect is all these people coming back into the workforce. We're really not even seeing the full force of what happens when people try to find jobs. They expect the unemployment rate to tick up. But when you look at people who have left the industries, who have left their jobs, about 2/3 of those have left for purposes of either retirement or disability. So only 1/3 of that differential in labor force participation is coming from people who actively seek work, which to me argues that you will have a little bit greater wage inflation because there's simply less workers to fill jobs. So this is our optimism that we will get a little bit of inflation.
Wage
with the Fed
inflation?
moving.
I'd like to see it.
I mean, maybe not 3 or 4%, but certainly this 2.5% number with coming in across the board, across all types of workers, that's really a point of optimism for us to see those things converge.
Meg, great having you with us.
Thank you.
Always. Meg McClellan, she is with JPMorgan, Private Wealth Management, right?
Asset management.
Asset management.